Ja, det har varit en svart måndag på japanska marknader. Det har varit neråt på många håll i världen. Men alla asiatiska börser har inte drabbats likadant. För att diskutera detta har vi med oss Kelly Chen från DNB. Hon är en Kina-fokuserad ekonom. Vi fortsätter samtalet på engelska. Kelly, wonderful to have you with us. Thank you for taking the time. First, I want to pick your brain on this rather dramatic development that we saw mainly in Japan. I know it's partially a carry trade in Japan, but I want to hear your thoughts about the drivers behind this downturn.
Yeah, thank you very much. I think much of it has been the carry trade unwinding. We saw that the Bank of Japan raised rates quite surprisingly last week. But also we had the broader risk-off sentiment after the very weak payrolls numbers from the US. And that's something that has really impacted not just the Japanese equities, but also broadly in all of Asia.
I'm curious, and this is very interesting. So the carry trade is local. People used to borrow money in yen, buy things elsewhere. Now they have to get out of those positions quickly. The broader risk-off is obviously broader. I'm particularly interested in Taiwan and South Korea, saw pretty steep downturns as well. Do you have any feel for why some markets were more impacted than others if we look at the Asian perspective?
Yeah, definitely. We see that there's a predominant tech sector impact to this downturn or correction. And of course, South Korea and Taiwan are very impacted by this tech correction. So you have TSMC in Taiwan and a lot of the South Korean companies that are related to the sell-off in AI and tech stocks that are really pushing the markets there downwards.
And if we look at mainland China, I know China is your main expertise. What has the development been in markets there overnight, and what's the short-term market sentiment?
Well, in China, the decline has been much softer. I think it's down approximately 1.5% in some of the biggest A shares. So that's the local Chinese markets, as well as in Hong Kong. And there are a couple of reasons for this. I mean, the Chinese markets, they've always been protected to some extent by the so-called national team in China, and that is the state-owned financial enterprises that will come in and they will purchase stocks in a period of weakness, and we've seen some evidence that that has happened. In addition, we've had some positive-ish news coming out of China on Friday simultaneously. It hasn't received that much attention, but the Politburo, so that's the Chinese government leadership, they've come out with some reforms that are aimed at improving urbanization and urban spending, which could be positive. But I would say primarily you don't have that much direct impact from the tech sell down. You have protection from the national team, and then you have a bit of positive news from the reform side of things as well.
I also want to ask you about valuations. The Japanese stock market has been going very strongly. In China, we've been reading about Chinese economical problems for years now. So I imagine that Chinese equities are relatively cheap. I wonder if you see a protection from valuation when you compare these markets.
I think if you look at China, it's been cheap for a very long time. It's been increasingly cheaper as well. So the argument that will protect pricing or that it would trigger maybe even a relative outperformance in China is something that has always been there, but it hasn't materialized. So I think I would be cautious on hoping for too much on that front.
How about contagion risk? You mentioned that the risk-off sentiment is obviously broad. The Japanese currency issues are local. Could you talk a little bit about risks and how much connection there is between Japan and Chinese markets? Do they usually move together, or can they function separately?
Certainly they can. And in this case, we have seen that they have. What I'm arguing for is not that Chinese equities will have to weaken. What I'm arguing for is that the idea that there's going to be a liftoff in China is probably going to be quite misplaced. And with this broader risk-off sentiment globally, that broad risk-off sentiment is going to have a much stronger dampening effect in China than what you would expect.
So if we're going forward looking at Chinese markets, what are the most important factors to keep an eye on? Will it be government stimulus, or would there be the well-being of the consumer, or something else?
Both, I would say. For the good part of this year, we've been seeing very weak consumers from China, and we've also seen a non-existent or only a drip feed of stimulus from the government. Going forwards, we don't see any really big changes for the consumers. And on the government side of things, the only thing that we believe will trigger more stimulus would be increasingly turbulent times. We know there's an election coming up in the US, and our argument has been that the Chinese government has been retaining some fiscal and monetary space in case of more turbulence in the quarters ahead under potential President Trump.
That's very interesting, because we've been changing away from the notion that bad news are good news for markets when we look at American markets, but it sounds like we could still keep this perspective on China a little bit. If worse news occur, the Chinese central bank or government will somehow have some muscles saved for helping the markets there.
Yes, and then the question is how much compensation is it really when there is more support from the Chinese authorities? Because after all, when they do loosen up their money bags, when they do, empty out the fiscal and monetary policy space that they have, it is in response to something. It is in response to headwinds that are coming. So I would be a little cautious as well. Sometimes bad news is also just bad news.
And that's been very true in markets this dramatic Monday. Kelly Chen, wonderful to have you with us. Thank you so much for joining, and talk soon, I hope.
Yes.